All right.
We're live. We're live.
Yeah. So you should be able to see the link that you posted also go live. Also, that's the same thing for Facebook and for LinkedIn and for YouTube as well. That's the 3 channels that we are live on right now.
Cool.
And you can see the comments come in on the right. There's a little button that says chat. Wait. Where's the chat? Oh, comments, sorry. There's a little button that says comments. That's where you can see the comments come in from everybody. So
I see.
let's start. All right, guys. So we are live on Business and Beer again. This episode is really interesting because we have a VC with us. For those of you who are unfamiliar with the term, VC means venture capitalist or venture capital. But let me just do a proper introduction. So for all of you who are new to this channel, this stream, my name is Alvin Poh. My background, in summary, is that I started a tech company. I bootstrapped it with $0. I scaled it up to $30 million, sold it, and for 2 years, I was traveling the world full-time, but I've since returned to Singapore, and now I'm coaching entrepreneurs because I want to show them how to scale up the right way. And today, I have a very special guest. His name is Lance Quack. I say special because I'm a bootstrapped entrepreneur, right? The way I run my business is that, I started with 0 capital. Everything was all self-funded. Lance comes from he's an entrepreneur as well, and that's what we're going to dive into. But he is a VC, which is particularly interesting to me because I want to find out, how does a VC look at business? How does a VC look at like startups, right? And see whether or not they're going to succeed. See whether or not they are going to make a difference. Anyway, Lance has a pretty interesting background as well because he didn't just start as a finance guy. He was an entrepreneur also. He was a co-founder of a cloud computing company, and he sold that. After that, he became an angel. He became a VC. He started his own VC fund. So this session is going to be super interesting. His VC fund is called Gamer Force Ventures, which is something that I'm going to talk to him about. Apparently, it covers esports, gaming, all the tech that's involved in that as well. And this is global, right, Lance? All right, cool. So we're going to talk about that also. For all of you on the stream right now, welcome. I see Arthur. Hi, Arthur. For the rest of you who are here, just say hi. Today, I just want to talk real quick about the beers that I'm drinking. I don't know if you guys have beers, but you're welcome to bring on a beverage. I've realized that business and beer is very, very limiting. But if you have a beverage of your choice, bring it on. I know people have been drinking tea the last few sessions. That's absolutely fine. I don't know what you're drinking, Lance. It looks
Pretty much a mixture of some juice, some grape juice and some 100 plus. That I decided to just, for the sake of this and beer, right? I might as well just put it in a champagne glass.
But there's no alcohol in your drink.
Yeah, so it's because partially because I was allergic to alcohol, partially because I don't want to get knocked out halfway during a stream. So
I don't know about people, but I think I would like to see that. Suddenly talking about business, suddenly like knocked out. That's kind of cool. So everybody is free to have your own beverage. For me, I have beer. This beer is brought to you today by Western Collective. It's a few cans that have been sent to me all the way from Boise,
wow.
the US. So, Boise, sorry, from the US. So it's amazing. This is actually a hard seltzer. It's not really beer, but it's a hard seltzer. Good stuff. Anyways, I see a lot of people on the stream right now. Daniel is here. Hey, Daniel.
Hi, Daniel. Hi, Samson.
Yeah.
Yeah, business and coffee, interesting. Don't scale your alcoholic threshold, Yeah, thank God I won't.
All right. No, we're going to keep today's conversation to business. It's going to be a really interesting conversation because Lance comes from a background where he's not just a VC, not just a finance guy. My main gripe with venture capitalists is that most of them don't understand the whole concept of entrepreneurship. Like, to me, entrepreneurship is not just a way to make money. To me, entrepreneurship is the way, it's a purpose. It's passion and profits, right? Like, to me, like, passion, purpose, that's more important than profits. Profits come after you've developed and you're able to deliver the kind of value that you want to your customers, right? So that's more important to me. That is the true nature of entrepreneurship. And that's why I have this like, and this is something that I think a lot of people understand as well, or have like learned about me. I typically do not like your traditional, conventional VCs, primarily because they are so profit driven, they're so performance oriented. I say this because I've actually spoken to a few VCs before while I was like running Vodian, and they were interested to purchase and acquire Vodian. And when I went through all those talks, right, I realized there's an immediate and very, very apparent difference between us. The fact that they were very profit-driven, very finance-driven, was so stuck in comparison to how we ran the business. Me and my co-founder, we were always about like value. Like, how do we make it so that it was a better web hosting experience for everyone? So I don't know what stand you come from. The fact that you are an entrepreneur before, I'm pretty sure that you have very, very different concept of VC. So I'm very, very interested to find out about that. Hey, Felix, good to see you.
Yeah, nice to see you, Felix. So actually, interestingly, right, I guess what you realize is 90% of the VCs tend to be run by like ex-investment bankers, ex-hedge
Exactly.
fund managers. You know, here's the thing, right? In hedge funds, right? Here's what one of my good friends actually told me before, right? In hedge funds and in banking, you are actually punished for your mistakes, right? So you're not incentivized to take risks. But in real VC cases, what you're doing is actually you are paid to be optimistic, in the sense that you try to look for founders with businesses that are unproven but have the potential to give you 100x, 1000x, right? Because if you look at how most VCs do it, they typically invest in like 20 to 40 companies. I've seen a fund that specifically states they will invest 100 companies per fund, right? So given that kind of numbers, right, what they are trying to do is they're trying to figure out, hey, out of that 100 companies, right, how many people in that 100 companies will succeed. So the challenge for that is being able to figure out the best entrepreneurs with the best business model that can scale fast, right, and give them a good exit in 5 years, right?
Yeah, exactly.
Unfortunately, that's what the investors of the funds want, right? They want you to generate that kind of crazy returns because they're saying that, look, I'm locking my money in with you for 8, 10, 12 years, right? You got to pay me for locking in that money for 8, 10, 12 years rather than putting it on the stock markets. So there is a reason why VCs do certain things, but I feel that the best VCs, right, will get who are founder friendly, who understand what founders go through. These guys are going to be the ones who get the best deals, and I mean those are the ones that are going to generate the crazy returns for you. So if you look at top decile funds, right, people like Sequoia, people like Wavemaker, what you realize that is that the partnership, right, is at least 50% held by former entrepreneurs / executives, right? It's not a bunch of bankers who come out and say, "Hey guys, sorry, I have nothing against bankers, by the way. So if you're a banker, don't burn me at the stake," right? But the thing is this, right? You need to understand what the entrepreneur thinks, right?
Yeah.
Let's be honest. How many of us here, right? Alvin, I know you are an angel investor. I mean, we co-invested in a deal before. Let me ask you this, right? When you look at the financial projections of a startup that comes to you, what comes to your mind?
Like, bullshit lah. You don't even know whether this is going to happen or not. Like, I don't really care, honestly. The projections are like, honestly, it's secondary. What I care about is I honestly, okay, so the startup that we invested in, I was looking at the founders. I was looking at how passionate they were. I was looking at how experienced they were. I was looking at how confident they were, their competence, right? So I was purely evaluating on a personnel, individual, people kind of perspective, not finances. Like, you can show me the nicest slides, like, oh wow, we project that we will get like 100 times returns in 2 years, like 3 years we will be like 10 times and all that, right? But honestly, I know the entrepreneurship journey is not a straight line. It's going to be like ups and downs, and honestly more downs than ups. So to get over that, it's really not a matter of how well you project your finances. It's really your resilience. It's really your competence. It's really like your passion and purpose. To me, the startup that we invested in, they had all of that, and I was like, I loved it. Right?
I agree.
And their founding team, they had a good mix. There was a business person, there was a tech, and he was good at the hardware. So when you mix those two together, you get a really, really good fit, and they worked well together. So to me, honestly, I don't really care what they do as long as they go do it. That was my investment thesis.
Yeah, likewise. In fact, I was just saying, right, when you look at the founders, right, the key question I always ask myself is, when I evaluate founders, I know this will be controversial. Not many VCs do this, actually. We try to at least get a 30-minute meeting with the founders when we first start, right? When they apply to pitch to us and all that. And typically that is led by either myself or one of my venture partners. All three of us are entrepreneurs. We became an entrepreneurial background. And what we try to do here is, we always ask ourselves this question: if today I were to leave the firm and we're going to start a new business, would you come on top of my mind based on what you tell me to be my potential co-founder? Right? So the challenge is, when you look at these guys, I always ask myself, right, can I trust this person? Am I able to work with this person? Right? Because at the end of the day, when you invest in a startup, I always say that it's getting married for the next 5 years at least.
Yeah.
Right?
At least.
Yeah. And more often than not, startups take at least about 7 to 8 years, typically, to give you a decent exit. Right? I'm not talking about things that give you 2 times, 3 times. I'm talking about things that potentially can give you 10 times, 20 times. Right? Because that's what we are gunning for. Right? Like I think Felix mentioned earlier that he used to work for a hedge fund and a fund of funds. We never made mistakes and always get paid, but no such thing as 100x in a hedge fund. VC is more interesting, definitely. I agree with you on that. Right? Yeah, it's a 5-year marital tenancy. Yeah. So I always say that, can you imagine you don't like to work with a guy and you got a slog and talk to the guy for 5 years, and then he just causes you to pull your hair out? Can you imagine that? Man, I'm not gonna do it. I'll rather just say I'm out. Right?
Yeah. So I mean, to me, that's the whole. I mean, I'm in entrepreneurship because I love creating impact. I love creating value. Like the fact that people's lives get better because of what I do. I think that's awesome. And when I say people, it's not just my customers. It's my team as well. It's my suppliers. I think it's the ecosystem. And to me, that is the true nature of entrepreneurship. It, to me, is a huge form of responsibility. And that's something that I really, really like. Wow, so we got a few questions. Dalton has asked if there's a difference between VC and angel investor. Yes, Dalton, there is. Lance, why don't you take that question? I'm sure you will.
Let's see. Let me pull this. Let me be able to pull out some slides.
Yeah, can. I'll end the stream and then you can see it. Yeah, there we go.
Yeah, cool. Yeah, so this is what you see on the screen, right? Is how a VC structure typically works. We typically take in money from other investors. So that's VC, right? So these guys could be angels like Alvin, right? It could be family office. So family offices. So these guys are super high net worth families. They created a vehicle to manage their investments. It could be sovereign wealth funds like Temasek, GIC. Could be corporates like Activision, Blizzard. That's one of my That's actually one of my target LPs. But anyhow, or institutions, right? Like just how Felix mentioned, fund of funds. Yeah, so these are institutional investors. So what we do is we actually pull the money of these people. We create a pool of capital that we invest, right, through a venture fund, right, into portfolio companies. So think of angels as having the same general partner, same investment manager, same limited partner, same fund, right? Everything over here. Can you see my cursor? Yeah.
Yeah.
Everything, all this part is the same person, right? So if in Alvin's case, or if I'm investing in a personal capacity, in my case, what happens is all these gets crossed out and it becomes Alvin or Lance, right? Or whichever angel, right? And then you just have portfolio companies over here, right? That's angel investors. Angel investors use their own money. VCs use other people's money, right? So that's the main difference. Of course, there are subtle differences of how what VCs look for and what angels look for, but I won't get into get into much details on that. Typically, the idea behind it is angels tend to invest for more than financial reasons, while VCs tend to invest primarily for financial reasons because they got to account to these LPs, right? They got to account to their limited partners, the investors that take on invested in that fund, right? So the thing is, if you are a fund manager, the key question is why limited partners come to you is because they believe that they can make money for them, right? So that's what you're supposed to do, right? You're just doing a job. So if a VC is just focusing on like, oh, I invest for impact and all that. Let's be real, right? I don't think that's very true. More often than not, these guys invest for capital gains for the investors. So and also the other thing is like Alvin said, right? Typically angels have a longer timeline, right? For example, if we were to invest in the company ourselves, right? But as angel investors, typically we are open to the investment being held for more than 10 years. We are okay with that, right? But for VCs, because of the kind of time pressure that you are given, right? Typically a fund life is about 8 to 12 years. You got to liquidate all your holdings by then, right? And generate a profit. So you have the time pressure. You have the added time pressure. So that's I think the key differences between the two, right? Hope that kind of answers the questions.
Nice. I see that Calvin is also on the stream. Calvin is asking like really solid questions. What are indicators that you use to tell whether the founder or key man risk is being removed?
Wow, this is an interesting question, right?
Wait. Yeah. Wait, let's get more clarity. Like, Calvin, do you mean like startups way at the start when you're investing? Because if you mean that, right, like for me, that is secondary. That is secondary. Yep. Like when I look at my journey, right, in the first initial few years, yes, my co-founder and I are the key man, but honestly, there was no way to remove that. The whole business really just hinged on us two. Even if you like say, okay, like yeah, we buy insurance, we cover ourselves for like maybe 20K a month, get somebody else to come in. Honestly, I tell you that is a business that I will not invest in. So I think it takes time. Even 2 years, honestly, the initial few years of growing the business, and that is why I feel that the founding team is so important, because if the founders aren't there, I'm not even bothered. I don't really care. The business model might be great and all that, but I will not invest in the company. To me, the founders are paramount. So yeah, you might mitigate the risk by buying insurance or having like a succession plan, but to me, when that is in place, it's a really different investment really. It's a really different startup. It's a very, very different business. And to me, it's no longer the same.
Yeah. So actually brings me to this particular slide that talks about like how I view potential investments, right? I always ask myself, I always put it across two different metrics. One is about the business model, one is about a team. I always give more weightage to the founding team right,
Oh, nice.
than the business model. So typically I say, okay, because I always believe in this, right? Let's be honest. How many? Okay, Kelvin mentioned 2 years on. Typically, I would say even at this point, there's only so much you can do, right? You can only buy, let's say, insurance and all that. But other than that, honestly, I guess investing in startups, the key thing is you are already assuming key man risk,
Yeah.
right? So on term sheets, you can see all kinds of liquidation and all kinds of different weird terms that VCs tend to throw out. But let's be honest, if it works, it works out. If it doesn't work out, things still, the thing is, if the thing goes into liquidation, no one gets anything at the end of the day, right? So
Yeah.
maybe you get a little bit of money because of the liquidation preference, because you take preference shares and stuff. But honestly, if you want a 10x, I don't think so, right? So
Yeah.
on day one, we are already taking on that risk, and it's assumed that we are already taking on that risk. So yeah, that's how I see it. And
Yeah.
we always believe in the founding team because I always say that, look, in startups there are two constants, right? The first constant is change, right? That you can't change anyways, right? The second constant is the team, is the founding team, right? A business model can change, because I've seen many startups pivot, especially during COVID-19. Um, Spoke to so many of them, and the thing is, I spoke to them 2 years ago, and I spoke to them last year. The business model was so different, right? I mean, I've seen companies that shifted from a SaaS model all the way to a commission-based model, right? That company has raised a pre-series B round from Wavemaker, and today they are already profitable, right? So the thing is, but the thing is, what I realized about this company is the two founders, they they are really resilient, right? They have fought in the business for 7 years, right, to get to where they are, right? That is how they scaled across Singapore, Hong Kong, and multiple other markets. But from what I see is, right, you can always tweak the business model along the way, right? But the founding team, once the thing is, in startups, the most expensive mistakes that any startup founder can make is to hire the wrong people early. Right?
Any business. I think that's
Right.
super expensive.
Right. I mean, the thing is, can you imagine you hire somebody like, your, I mean, the thing is, can you imagine you hire your head of sales, and then that guy happens to run something that is conflict of interest to you, and then like he's siphoning your business away,
Oh, it's
right?
terrible.
That's terrible, man. So the thing is, on day one, you want to make sure that your team is strong, right? The business model can be changed along the way, right? So I always tell my founders that, look, there is one constant thing that you need to think about, right? Which is, if today things don't work out, how do I pivot? How do I shift to another business model that will work, right? So at the end of the day, and the other thing is, I always say this: skills can be learned, expertise can be built, but what you need is attitude and principles, right? That's what we
Yes.
look for,
Yes.
especially for a strong team, right? So what if you are the best coder in the world, right? So what if you are the best marketer in the world, right? If you don't have the right principles, if you don't have the right mindset, and if you don't have the right attitude, right, to running a business, my question then, the thing is, why are you doing it in the first place, right? I know I sound harsh, right? But I feel that that is something so important, right? And how do we tell a business can be successful? Thank you for the question. I always say this: first thing first, look at the founder, right?
Yeah.
The key question is, I always like to say, you want to work with the founder for like 2-3 months before you make any investment, right? Especially if, let's say, you just met them at a pitch day, or you just met them at a networking event. You want to speak to them for 2-3 months, get references, and don't take the don't when they give you like the list of customers, right, and they give you like a couple of names, right, for references, don't call those people. That's Don't call those people. You never know. You never know whether they have discussed and say, hey, can you help me out? You know. But the thing is, you want to get references. right? You want to understand how the founders are treating the employees. You want to understand how the founders are treating customers, because I think that's very important. Customers are the lifeline of your business, right? And of course, how the founder is thinking about scaling, about growth, right? Which is where I think Alvin is super awesome at, right? Later, I have a gift for you guys. I won't talk so much yet, right, about it, but let's bring it at the end, yeah. So, but the other thing is, you talk about the business model, right? I always ask myself, does this business model have, or rather, does this industry and this business model have a large enough target addressable market, right? So we will actually tend to do a market sizing, either a top-down approach or a bottom-up approach. There are many ways. The thing is, to do a market sizing, it takes a 2-hour lecture that I went through myself online. So I won't bore you with those information. But generally, I want to look for a market that is at least $1 billion or more, right? Some angels are okay with 100 million. Given that I'm taking money from other people, I better make sure I'm looking at something with a larger market size, right? So the other thing is, you talk about traction, right? I always ask myself, how much has the team raised previously, and how far have they come based on their previous investments that they raised, right? Because that gives me a proxy about how well you can execute a business, right? In case you are thinking about raising capital from VCs, they typically will call your earlier investors and say, "Hey guys, I saw this particular deal come through to my office. I understand that you are an early investor. What do you think about them? Right? What's your take? Right?" So the thing is, I always say this, right? The investment community is so small, right? Honestly, I've seen founders that go VC shopping, right? Some of them have already signed an exclusive term sheet with me, or signed an exclusive term sheet with some other VC and come to me for an additional term sheet. I told them, look, guys, you dare sign an exclusive term sheet with someone else and you dare come to me for another term sheet, I'm going to report you, man. Because I think that's a breach of trust. I think that is, and I don't believe that, yes, I may lose out on the deal, but, I want to see, I'd rather lose out on the deal than invest in a founder that is not, doesn't have integrity.
Yeah, I think that's super important because it goes both ways, right? Like, imagine this time around, that guy comes to you, but that guy, if you don't, if you change, if you switch the tables, change the tables around, right? You could be the guy that he signed an exclusive with, and might have just gone someone else. So that I think is the true meaning of integrity, right? It's the golden rule: do unto others what you want others to do unto you. Right. Okay. So we got a few more questions. Sam Chua has just came on board, and he's saying that this is like a hiring manager's perspective, and I think that's really cool because the one thing that I realized recently also is that whenever we look at anything, in the past I used to think business is business, personal is personal, family is family, friends is friends, right? But I realized, and relationship is relationship, but I realized that as long as you talk about people, as long as people are involved, whether it's VCs that we're talking about, or business, or relationships, or personal, or hiring, or whatever it is, as long as there are people involved, guess what? It is going to be the same. The concepts and principles are going to be the same because you're dealing with people. People all operate on the same fundamental basis, no matter what aspect it is, either business, personal, family, whatever it is, right? It will all be the same. So the stuff that we, like Lance and I, are talking about in terms of VC investments, angels, the one thing that actually we've already established is that the founder is key. The founder is more important than the business model. And when we look at founders, it's a personal thing. It's personal not because we like the person, but personal in the sense that we understand what drives the person. We understand who he is. We understand his core values. We understand how he ticks, how he operates. And because of that, we are confident that no matter what the business model is, this person will be able to do a good job. And this is the same for like what Sam Chua has mentioned, right? Hiring someone else to join our team. Like as an entrepreneur, when I hire, I look for somebody that's capable, not just for the role, but like more in general. Like he's resilient, he's capable, he's competent, he's responsible. He has the core values that I think make an A player. And that's why I hire him. That's why I feel like he will be a good fit for my team. And I say my team because this is going to be completely different. Like Lance could, no, his version of what an A-star player is going to be completely different from mine. Right? His values is different, personality is different. When he runs a company, the kind of company culture that he creates is going to be different. So yeah, I really like that Sam Chua brought up that question because I think that kind of illustrates the similarities and the differences also between all these areas that we're talking about. Yeah, hey, Lance, did you see Ang Teo's message? He also asked about the fact about, like whether or not most incubators and accelerators run by VCs.
Can we pull that out, please?
Yeah. Let me just highlight this.
Yeah. Okay, so are most incubators, accelerators run by VCs? When is the right time for a business to approach a VC? Okay.
Yeah.
Here's my
Lance,
take.
give me a second.
Sure.
Okay, so we have quite a few of you on stream live right now. I'm sure all of you are liking this and loving this. If this is of value for you guys, don't just consume, don't just take the information for yourself. I just need you guys to like, share this stream to other people who might take value from this, right? Lance and I are just gonna spend like an hour or two just talking about business, talking about VCs, what makes a business successful, what makes a business not successful, right? All these things that are very, very pertinent. And I'm sure this applies to a lot of entrepreneurs, which a lot of you are. So if you like this, please just click on share. I guarantee you that share button is going to be free. So just click on it. Get more people to enjoy this. Get more people to take value away from whatever we are doing right now. Yeah, sorry to interrupt you, Lance, but go on.
Yeah, no worries. Yeah, please share. Please get as many friends as you like. Who you think you can add value? We can add value to this. Yeah. So just talking about this, right? Incubators, accelerators run by VCs. There are, right? I know there's an accelerator coming from the States, mainly in Silicon Valley. What you're seeing is people like 500 startups. I think Sequoia runs an accelerator as well. They invest $1.5 million per company called Search. So you do see a number of incubators and accelerators run by VCs. So these are actually what I call them scouts, in the sense that, for VCs, what we look for is, if you look at how we actually pick companies, right, the typical numbers. Okay, sorry, this is KPI. Why did I bring this to KPI? Right, numbers. Yeah, the deal funnel. Yeah, apparently the link hyperlink went wrong. If you look at it, right, 3,000 companies, right, come through the discussion door, right, with us, and then we do about 10 deals out of that, and out of that only one exits, right? So that's the cold hard truth, right? So the thing about incubators and accelerators that are run by VCs tend to be like trying to increase this number, this 3,000 number, right, to allow us to have a better sensing about the companies that we might or might not want to invest in, right? But I do see a lot of independent accelerators and incubators that are running their own funds as well. So what you see is guys like Accelerating Asia, pretty good accelerator if you're thinking about going for it, right? There's 500, as I said earlier. In terms of incubators wise, in Singapore, you see guys like Startup O, you see guys like Ansler, Entrepreneur First. In the States, you are looking at guys like Y Combinator and stuff. So these guys tend to have their own funds, but I wouldn't consider them VCs because they tend to be either a little bit too early, typically, for venture funds, unless you're talking about seed funds, like for our case, Gamer Force is also a seed fund. So typically we may invest at the same stage, but most of the time when you talk about VCs, these guys tend to go at what we call Series A, right? Series A is the first institutional round that you typically raise. Round size is typically between $2 to $5 million US, right? So if you're talking about Series A VC, they tend to invest later, right? So if you talk about when, so that brings me to the other question, right? When is the right time to approach a VC, right? Here's the thing, there's no right time, right? It depends on what is your business model, right? What business you are in, right? And B, what is the VC looking for, right? So for example, there's no point for you to, let's say, approach, if you're a really early stage, if you're just an idea stage guy, there's no point approaching Series A VCs or Series B VCs like people like Monk Hill Ventures or B Capital Group, right? There's no point going there because they won't be able to invest in you, right? Put it very bluntly, right? Alternatively, you may not want to go to people when you are at a later stage where you have, let's say, 10 million in sales. You may not want to go to maybe a Series A VC because these guys are too early for you, right? So you need to have an understanding of what the VC is looking for, right? So typically, when you look at the website of a VC, they'll sort of give you a sensing. What is the kind of investments that they are looking for? That's what we call the fund mandate, right? Because that is what they propose to their investors, what we call limited partners, right? So for example, my case, I tell my limited partners, guys, let's say Alvin is my LP. I say, Alvin, the investment thesis is we're looking at esports and gaming technology companies around the world. We usually invest between seed to Series B, right? So if you're coming to me as a series, trying to raise a Series C, sorry, I typically don't invest in that, right? If you come to me at Series A, I might invest. Series B, a little bit too late for me, although I don't mind investing if the valuations and traction is right. But typically, you need to understand what the VC is looking for, right? Are you looking at somebody who is going to? But typically, a good head start, right, is you are already having a good business model, right? Your product is what the market needs, what we call product market fit, right? You have found early customers, and now you're raising capital to do two things, right? A, improve your product, and B, more importantly, to scale, which I think Alvin can do it very well, and he will teach you in his masterclass really well, right? So I guess that answers the question, I hope. Yeah, I hope that covers sort of gives you a sensing of how we typically do business.
Yeah, hopefully that answers the question, Ang Teo.
Yeah,
well, a lot of you
Felix,
are on stream right now. I see like at least 27 of you just on Facebook alone. So hey,
wow.
if you guys appreciate this, just like and click on the share button. I guarantee you it will not cost you anything. So share this with people that might actually appreciate this. Lance, we have a question from Felix. Felix is asking, what is tougher, a mediocre business pitching to a good VC or mediocre VC pitching to a good business? What do you think, Lance?
Wow, tough question. You're putting me in a spot. Okay, here's the thing, right? If you ask me, a mediocre business pitching to a good VC, you're getting sweat. You're gonna get sweat, right? Because the thing is typically in the venture capitalists will tend to grill you, right? They'll grill you down on the numbers, they'll grill you down on your cap table, they'll grill you down on how much you have raised, what's your current traction, what's your operating model. They will grill you, right? That's the truth, right? I don't want to give false impressions. That's the truth of life, right? If you're raising capital from a VC. Now, you talk about a mediocre VC pitching to a good business. That's an interesting point because today we are seeing a lot of capital flow going into startups because more rich people want to say, hey, you know what? Let us invest in innovative companies and stuff, right? So you are seeing a lot of family offices, you're seeing corporates, you're even seeing later stage private equity funds coming down, right? The thing is, recently I'm not sure whether Alvin saw this, but a Series A VC actually came down to do a couple of pre-A deals. it was Alvin, I'll PM you later about this, right? I want to name names because it's not nice. Yeah, but that's what we are seeing today, right? Later stage VCs are coming down earlier, right? You also see earlier VCs going up later, right? So you're starting to see the lines between private equity and venture capital starting to blur a little bit. But the thing is, for me, I always believe that you need both, right? Honestly, which is tougher? I'm a little bit towards the mediocre business pitching to a good VC. But of course, if you are a mediocre VC pitching a good business, to get them to take your capital, that's also tough, right? So I'm just a little bit slanted towards the mediocre business pitching a good VC. Hope that answers your question, Felix.
All right. We have a lot of really good questions, man. Not just Felix, Arthur, Ang Teo are asking. Like, we have one more coming in from John Ho. John is asking, from an entrepreneur standpoint, beyond the money, what do we look out for in a VC? So I can give you some perspective. When I was running Vodian and I was looking at VCs and PE firms and all that, so there was a lot of interest, primarily because Southeast Asia, from a hosting perspective, cloud hosting perspective, was heating up. The US and Europe have been markets that have been like consolidated. And now all these big firms, the venture capitalists and the PE firms, they were looking at Southeast Asia because Southeast Asia was the last bastion. When you look at the whole world, like Southeast Asia was it was huge. Like, I don't know if you guys realize, but if you look at Southeast Asia as a population and a market point of view, it's huge. It's like even bigger than the US. The problem is with the Southeast Asia is that there's a lot of fragmentation. So comparing Southeast Asia to like the US, the US is very, very homogeneous, right? Everybody's almost the same. What city, what state they're looking at, yeah, there might be differences, but at the end of the day, you're just looking at a North American, and it's quite the same. When you look at Southeast Asia, you have all the ASEAN countries. You have Singapore, Brunei, Cambodia, Indonesia, Thailand, Vietnam. All these people are very, very different. Language is different. Ethnicity is different. Culture is different. And when you think of like going in as a SaaS or a business or a startup, you have to take all these things in mind, which is why even the super apps like Grab, they have difficulties expanding because when you look at Singapore and Indonesia, there's like such a big difference already, much less like all the other countries that you're considering. So yes, when I was looking at a potential acquisition partner, one of the things that I consider as an entrepreneur is what is their intention. When I look at VCs and PE firms, a lot of times for those that I speak to, all that they want is, hey, you guys are doing a good job, right? Like in 3 or 5 years' time, what we look at you is we're gonna grow our money like 5 times, 10 times. And the way we do it is we're gonna squeeze you. What you think about, I think about the customers, right? Like customer experience, customer satisfaction is key. If you look at my support operations, you look at the metrics that I look at, all that is not slanted at productivity and squeezing performance from my team. It is looking at how the customer can get the best experience, how the customer can get the best kind of support to do what he or she needs. To a certain kind of PE firm or venture capitalist, that may not be the case. That may be like wasting money. That would be like, you know what? Why are you spending so much money on customer support? If you remove these people, we put in like maybe just software or whatever it is, and we can increase profit like 2 times immediately. The reason why I don't do that is because it affects customer satisfaction, it affects customer success, it affects customer support. So that is why I don't typically go ahead with deals like that. And to entrepreneurs that might be considering, I think that's something that you need to do a discussion with. And that's what Lance talked about, right? It's like a marriage. So when you want to consider somebody, you got to find out what's their intention, what's important to them, and whether or not it makes sense to you as a founder. I think the biggest case of this so far is WhatsApp and Facebook. The WhatsApp, yeah,
No, bro.
yeah, like I mean, everybody can see this because it's public right now. But the WhatsApp founders, they were true founders, right? They loved privacy. WhatsApp was founded on encrypted conversations. Like you couldn't get anything out of there. They didn't want advertisements at all. Right now, because they've been acquired for a few years, so just so that you guys might, some of you might not know, but the WhatsApp founders have already left. WhatsApp has now been completely run by Facebook. And I think there's a recent fiasco where everybody has been moving to either Telegram or Signal because of the recent Facebook terms and conditions that they made everybody like adhere to, right? And that I think to me is what you're gonna get if you get into a wrong relationship with a potential investor that does not have the same kind of alignment. Not just VCs, not just private equity firms, but you could even go with an angel that is not aligned with you, and that is the danger. So investments are not free. Investments come with a great cost. I think equity is the most expensive thing that you can, as an entrepreneur, that you can let go, that you can sell. So I think it's very, very crucial that you think of those things, not just in a VC, but in any investment that you want to take on as an entrepreneur.
The thing is, Mark Cuban was saying, right, the best equity is sweat equity, right? If you're able to kind of like just go through with sweat equity, just go through with that. Honestly, VC is not the only way to scale. I know when I say this, I'm actually cannibalizing on my own business, but for the sake of because this is a show about entrepreneurs, I think I want to tell you guys this, right? Don't just see VCs as a path just to scale, right? If that is the case, right, I think everyone would be rushing to VCs, and people like 500 startups would be raising a fund every single year, right? Because they invest 100 companies per fund. Imagine trying to invest 100 companies per fund. Every year they raise a new fund. There's more. I'm pretty sure more than 1,000 companies approach them every single year. So, anyways, speaking of which, right, I just want to tell people this, right? Do your homework, right, on the VCs before approaching them. Look at what they are investing in, right? Look at the portfolio. What is the industry they invest in? What stage, right? You need to sort of understand the investment mandate, although you don't get to actually see it unless you are an LP, right? I would say, for example, if you look at these guys, right, Golden Gate Ventures, Quest Ventures, I think Alvin spoke to Yiping from Quest before, right? They usually look at marketplace, B2C, although I think they are now slightly more agnostic, right? If you're talking to people like Elevate, you are talking to people who are looking at B2B tech, right? Same for Wavemaker, right? So you need to sort of understand where they are, right? What is the requirement they are looking for, right? Is it because, must you already have revenues? Because that is one of the key questions that a lot of VCs look for, right? If you're pre-revenue, it's really difficult to get VC funding, not because of what you are, of you, but because that's usually how it's structured, right? How funds are being, when we write what we call the LPAs, right, which are the documents that we actually sign as a firm together with people who invest with us, right? So that's the kind of things that we are forced into, right? Put it very bluntly, right? The other thing is, of course, you have to understand how they can add value. Are they able to help you with future fundraising rounds? Are they, because of their branding, are they able to bring you strategic partnerships? I think Insignia does that very well, in a sense that they have very strong LPs. People like CP Group, from what I heard. That one you need to check with the Insignia guys. But I heard they just helped one of their portfolio companies link up with CP Group to launch a partnership, right? And I heard CP Group was the LP. So the other thing is, for the entrepreneurs out there, please stop using buzzwords, right? for me, it's a huge red flag, right? Don't come and tell me, oh, we are an AI company built on blockchain with cloud computing, with quantum and stuff like that. Just stacking buzzwords for goodness sakes, guys. We can tell you that we don't buy into that, right? We buy into companies that really have a business model. We buy into companies with really strong founders, not a bunch of buzzwords. Don't expect a 50 million valuation just because you have a whole bunch of buzzwords, right? The other thing is we always want to understand, what is your story, right? What brought you into this company? What made you start your business in the first place? And I think it's important not just for founders to, VCs to understand founders in that way, but I think the reverse is true as well. What made the VC decide to speak to you, or what made the VC even start the fund in the first place? Which I think there is a question about that. We can answer that later.
Yeah, talking about that.
So we always talk about please don't be a walking zombie when talking to VCs, because the thing is we are looking for your passion, your enthusiasm, right? If possible, some experience, but I always say experience can be garnered over time. Not many VCs agree with me on this, but the thing is, I always believe that skills and experience can be garnered over time. But the key question is, what's your attitude towards your business, right? And of course, know your industry, right? Who are they? Who are your competitors? Let's be honest here, right? Every day you are not working on something in your business, your competitors are, right? And competition fights back, right? So you want to know how your VC can help you with that, understanding, your growth strategy. Are they able to help you with things like marketing? Are they able to help you with things like partnerships? Are they able to help you with operations, HR? I see a lot of VCs that are trying to do that now, right? Compared to like back in the days where I was running my own business, right? And the other thing is, founding teams with complementary skill sets is a plus, right? Like just now, Alvin and I, we were just talking about our common portfolio, right? You have a really strong tech guy with a PhD, and then you have somebody who has exited the business before as a CEO, right? I think that's a good combination, right? And of course, tell us what's your vision, right? And how we can be part of it, right? The thing is, yes, we may only be there for a short period of the journey because we have no choice, but tell us what you aim to do in the next number of years, right? And be honest, right, with us. And I think it's important for VCs to be honest with founders as well. I have a tendency, if let's say I would meet a competitor of my portfolio, and I will tell them straight in the face that, hey guys, we have invested in a competitor before, but our fund mandate allows us to invest in multiple competitors, right? So, and usually what we do is we make sure that the information between competitors are not shared with each other, right? If possible, we try to get a different partner to lead the deal for different competitors, so that different partners, you do your own thing, and then you just file the reports with the LPs, But having said that, right, don't let us find out we are hiding something until we are doing due diligence, because we will know, right? We have guys that look into your numbers. We have guys who look into your customer base and all that, right? The thing is, knowing a founder backed by your dream VC and getting a recommendation, I think that helps, right? Usually VCs get, the thing is, usually VCs tend to respond to two types of deals. The first are deals that are recommended by their existing portfolio founders, and the second are deals that are recommended by their LPs, right? So if you're able to get a hold on one of these two guys, it helps, because usually what happens is, the firm that I'm working on is a little bit different, because we tend to have the partners meet the founders on the very first meeting, but typically you are meeting an analyst. These guys tend to be MBAs, or maybe they have worked in investment banking for X number of years, right? So the thing is, they are looking for these guys. You are talking to these guys who may or may not understand business, right? In terms of entrepreneurship, right? So you want to have a good relationship with that guy, and getting one foot in the door first, I think that helps, right? Talking about pre-revenue and post-revenue companies, pre-revenue basically means maybe you have a product, or you just have an idea, right? You have not actually gotten money from your potential customers. Post-revenue typically means you have already started getting money into your bank, right? In simple terms, right? Let's see, where do we, any other questions do we have? I think Samson has a question about why I'm starting this fund.
I think this is a great question because to me, stories are very, very important also, right? Like, Lance, I don't really know your background. Like, tell me more. You used to have a cloud computing company, right?
Yeah.
Tell us more about that. How did you start that? What happened? And in the end, you sold it to a US company.
Yeah.
How did that
Yes.
happen?
So, long story short, my cousin was ex Microsoft. So he just left Microsoft and asked me, "Hey, you want to do something together with me?" It started off as that, and then because my parents were entrepreneurs, a lot of my family members were entrepreneurs. One of them even took his company to IPO twice. So I was inspired, right? I was inspired by that. I wanted to build something of my own. You know, in Chinese, you always say that there are two types of people. There's either your 创意代 or your 富二代. I don't want to be a 富二代, so I say I want to be a 创意代. And it started that way, right? So what we did was we were trying to get software on premise and on cloud to talk to each other, because we realized that there were a lot of double entries going on, right? So the challenge for that is, I mean, the thing is, number one is the Warriors. Number two, but more importantly, I feel it's when when the admin staff gets tired, you tend to make mistakes, right? Human error. So what we tried to do was to populate data across different software, right? So that's how we started. Got a couple of customers, built that, so scaled in Malaysia and Thailand. One of our clients happened to be a Thai subsidiary of a US based company, which decided to take us out, right? So eventually, that was how the business side of things, decided that I wanted to give back to the startup community, right? And started angel investing. Saw Alvin's name on the cap table of one of the company we invested together. Then after that, I said, look, there's only so much as an angel I can do, right? Because I have limited capital, right? FYI, my exit was less than $30 million, so it's nothing much to talk about, right? So I have limited amount of capital, but I want to give back to the startup community, and I want to inspire people that, look, anything is possible if you put your mind to it, right? So I decided to say, hey guys, what's next? What's the next challenge that we could go for, right? It's, I guess, starting a fund, right? Because as I said before in one of my posts, when you're starting your first fund, right, it's as if you're raising a venture round, right, from VCs, but this time you're raising from really sophisticated people. These guys are not easy, right? Not easy to deal with. I mean, if you think VCs are tough, if you think angels are tough, if you think raising $1 million seed round is difficult, let's switch positions, shall we? Right? I always say this. Let's switch positions, right? So the thing is, I said, gaming, esports. I was a semi-pro before.
Semi-pro esports gamer.
Yeah.
Holy
I was playing
crap.
Overwatch.
What game?
I was playing Overwatch, bro.
Wow.
But the community was too toxic, so for me, so I was out. But the thing is, I wanted to see what. But when I look back, I realized the kind of growth that the market is that we are seeing in esports, and I do see a lot of potential in the next 5 to 10 years, in terms of the technology growth, in terms of
Wait, Lance, I'm going to stop you right there because I'm still mind blown by what you said. Like, I didn't know you were like a semi-pro. Okay, guys, I know you have like about 30 of you watching this stream just on Facebook alone. Until you ask a question, you're on YouTube. I'm going to answer that real soon. For all of you watching in, who here is a pro or semi-pro in esports games? If you are, please don't be shy. Let me know because I'm very, very interested.
Press one.
I didn't know Lance was a semi-pro. If you guys, man, just drop a message.
Yeah, Sam, yes, correct. Gave up Overwatch because of toxic gamers. Yeah, too many toxic guys. Right?
Oh, man. Yeah.
Yeah.
Cool. Yeah, so that's something that's very, very fascinating because esports is definitely growing, especially like in COVID, right? Esports have grown so much. Why, right? In business, we always talk about competition. What is our competition? So when I was growing Vodian as a web hosting company, what is my competition? My competition isn't just other web hosting companies. My competition is Facebook, Instagram, Google. Why? Because what do people want when they want a website? The intention is to have a place where customers can get to them, right? That's all. If it's just for like a website, nobody goes to it, no business will buy it. The fact that they want a website is because they know that customers come find them. And so my competition isn't just other web hosting companies. My competition when I was running Vodian was actually Facebook, because Facebook allowed businesses and companies to set up their own Facebook page, Facebook group. They don't even need to have a website. So to me, that is competition. So that's why I think that's something is really, really interesting to me. I think competition, like, I don't know what businesses you guys are in. A lot of you are entrepreneurs, business owners. When you think of competition, it's not just your direct competition, but like who else, right, is in competition with you for the same target market, for the same solution. So I think that's really important to bear in mind. Yeah. So, sorry, Lance.
Yeah.
Tell us
sure.
more. Like, what will happen? Like, I know you're a semi-pro in Overwatch, and that's probably got you into the gaming and esport niche.
Yeah.
Where do you see yourself like 5 years from now? Like what Samson has asked.
5 years from now, I guess for us, what we are trying to do is we would have built our own accelerator program, right? To help entrepreneurs in this scene to grow, right? Because I believe that there's so much more potential, right? And we want to find the best entrepreneurs, right? So what better way to get value by giving value first, right? So I believe that's an accelerator program that we're looking at. Another one that we are looking at is 5 years from now, fingers crossed, we should be raising our fund tree, which we are targeting about $100 million in assets under management. Right. That's the I guess the thing is, if you look at the established funds like Golden Gate, right, their fund tree would be like somewhere around 100. So so that's our target, right? So two important things. One is setting up our own accelerator program, probably with collaboration with other VCs in the space. The other one is deploying a $100 million fund, right? So hopefully our fund 1 and fund 2 would do well. Fingers crossed, right? Yeah, but the thing is, I always believe in helping founders. In order to, I always tell people this: there are 2 ways to grow your portfolio. One is to increase the number of exits, right? And B is to increase the size of the exits, right? So if you're able to help, if you come from operational background, I think you are better able to help your founders, right, increase the chance of an exit and also increase the size of an exit. That overall generates better returns. So that's my own take, right? I know not many people agree with me on this, but that's just my own stance on investing and looking at founders. Yeah.
Cool. Hey guys, I know a lot of you are taking taking away great value from this. Like, we just need you guys to share this stream so that more people can benefit from it. That's all we ask for. We are doing this just because we want to give value back to everybody. I think these conversations will help everybody to give you a perspective of like what goes into a VC's mind, what goes into an entrepreneur's mind when he speaks to investors, such as VCs, private equity firms, angels, and so on. Like, if you guys are getting value from this, just share this stream, click on a little like share button, get more of your friends to enjoy this as well and take value away from this. You guys have asked a few questions. We are going to answer it right now. We have Arthur. Arthur asked a question. Lance, I'm going to show you on screen right now. Arthur is asking, if VC have invested in competitors before, doesn't it give a added advantage in terms of experience? What do you think?
Yes and no, right? Depends on what the VC sees it as, right? If let's say you are saying that the VC has invested in competitor before, he or she understands how the business is run, yes, that's one part. No, in the sense that sometimes they will be torn between, should I help this company more or should I help that company more, right? So for us, our stance is if we were to invest in two different competitors, we try to see whether or not we can make them collaborate. It's an interesting thought that I've been thinking about because the thing is, a lot of times we think of competition as just competition, but I believe in something called collaborative competition, where in certain cases you can actually collaborate. Let me just give you an example, right? Recently, you talk about esports, right? I was just looking at two esports organizations, one that we have invested, the other was invested by Insignia. They're not collaborating, although they are competitors. For a project that came from Cathay, right? So the thing is, if you ask me whether or not when we invest in competitors, I think importantly it's about respecting each founder. It's about respecting that you have invested in competitors and you do not share sensitive information about portfolio company A to portfolio company B and vice versa, right?
Yeah.
Other than that, I'm actually quite okay, right, when funds invest in competitors, because the thing is just it really depends on the fund mandate, right? I've seen the thing is, if you talk about 500 startups, you invest 100 companies for fund, what's the probability of not investing in any competitor of their portfolio, right?
Yes.
So the thing is, competition, investing in competitors gives an advantage if and only if the VC understands that you need to keep the portfolio company separate.
Yes.
In the sense that you don't feed sensitive information to the other side.
Yes, exactly. I completely agree. Because this is the same thing in the banking industry, right? So bankers, they serve a lot of clients, right? So I work with bankers, and when you work with a banker, you want them to keep whatever you have confidential. It's the same thing when you work with a doctor, when you work with a therapist, when you work with a counselor. You want to have confidence in the fact that when you talk and share and reveal things to that professional is professional enough to keep it confidential. So like when you work with a lawyer, the lawyer has a lot of clients, all of them business owners, all of them all in like certain spaces, but you know that the lawyer has a code of conduct, right? He is bound to that. He is, sworn not to share information between his clients. So I think that is what's important. Unfortunately, I think in the investment space, we don't have that code of conduct. So that's why, like what Lance has shared, it is very, very important to look at a venture capitalist or a investor from a personal point of view as well, and understand what drives that person. Is that person reliable? Have there been any red flags in the past? Because like what Arthur asked, right? Yes, it's important. Like if I am in like say a beauty niche, right? I want to work with a VC that has experience in the beauty niche because I know that he or she has the experience, the contacts, the networks to help me. Because when I take on investment, it's not just about the money. It is about the context. It is about how you can help me, right? So that is why the experience is definitely advantageous. I want to have a VC that is experienced in the niche that I am in. The key that Arthur has raised is, of course, then is that VC somebody that I can trust, that everybody can trust. If there are red flags, then that's not somebody that I want on my side. It's the same thing whether you're looking for, and this is what we talked about, like, 1 hour ago. We talked about it, right? Like in terms of relationship, we want a partner that we can trust, the same core values. In terms of hiring people, like Sam has asked, right? In terms of hiring, we want people that can fit our company culture, that has the same values that us. Because if you get somebody that's different, there's going to be a lot of conflict, there's going to be a lot of friction. So I think this is a very, very important point. It's again really, really based in human fundamentals, and that applies to anywhere that you interact with humans in. Cool.
Yeah, Alvin, I think there's a question for you actually. Glad you brought up the point about equity being expensive. Is it norm that incubators and accelerators ask for equity for business to join their program? What's your take?
They typically do. And the problem, not the problem, but the typical thing that with incubators and accelerators, right, is that they are pre-seed, they are pre-revenue. They're like literally the only thing that you have is a idea. And because of that, when you look at the resources available, the only thing that you have is equity. You don't even have revenue. You don't even have you can't even say, hey, you know what? I'll share my profit with you. You know what? I'm gonna I don't know, strike another deal. You can't. The only thing that you have as a founder at that point of time is equity. So if you do need capital, that is literally the only way, one of the only ways actually, that you can raise capital. And that's why when I speak to my the coaching clients that I have, right, the one thing that I really want them to have is revenue. Because once you have revenue, once you have profits, the tables are turned, right? And you have so much more of a bargaining chip. You have hey, you know what? I need money not because I want to survive, but I need money because we can grow. And if you invest in me, I will make sure that you grow as well. So the value proposition is completely changed. You know that you have a business model that works. You know that you have a business that works. The only thing is, if you want to come on board, I'll make sure your money grows with you, with me, with my business as it grows. So if you are looking at incubators and accelerators, unfortunately, that is the case that happens. Unless you can show them otherwise. If you show them otherwise, post revenue, if you're profitable, then you can lower down the equity, because what they're bringing on board is really not as important anymore. So I think, yeah. What do you think?
I think recently there you start to see a lot of incubators and accelerators using convertible securities.
Yeah.
So they don't actually take equity straight up. They kind of say okay, look, you're pre-revenue, you have sort of a product maybe, you may have potential clients, but I don't know whether you can close.
Yeah.
I can give you A, B, C, D, E resources plus money, right? I don't know how to value you at this point.
Yeah.
My sensing is maybe $3 million plus minus. But if you don't meet that kind of target, I want a 20% on discount off the next round. That's the typical kind of thing that we see today. In fact, even for seed VCs, we tend to do this kind of things as well. In fact, most of the deals I do are typically convertible securities. I don't usually try to go for equity for a couple of reasons, right? When you're talking about convertible security, what you're looking at is here's the thing, right? You need the money. I know that you want this particular valuation. I will never give you this valuation. I want to go in at this valuation, but I know you will never agree to it. So why not let's make life simple? That's what I always tell my founders, right? Let's make life simple. You want this valuation, I give it to you. Okay, but you got to show me that you can sustain that valuation in your next round, right? If not, why would I invest at this point? So the thing is, I said, if you fail to reach that valuation in the next round, I want a 30% discount, for example, of your next round. So the thing is, I'm at least assured an upside to compensate for the part that I have to come in earlier, right? So that's usually my style of doing things. Different VCs have different styles. Most of them like equity, stakes. I'm a little bit hesitant most of the time because I want to, I like to say that if we try to do anything, we try to close fast, right? Because we know how it's like to be a founder. And I always tell my founders, look, every day you are negotiating with me on the equity stake and all that, you are burning cash. That's the truth, right? You're burning cash every single day. You need the money to grow. Why don't I'll give you the money to grow, but you're gonna perform, right? So let's make life simple. Here's the deal. Take it or leave it. Right? So the other thing is, just now we talked about partnerships with VCs, right? I was recently at a conference and we typically we were talking about how to evaluate whether or not should we partner with a VC or should we not partner with a VC, and how harped up of evaluations we should be and all that. The thing is, at an early stage, I advise founders don't be too harped up over your valuation, because the question is like just now I think was it Arthur? He was asking about expertise and all that can be brought to the table by the VC. The thing is this: if you feel that, let's say for example, by the change of valuation, right, you're going to lose more than 10. Let's say you're going to lose 10% more. Example. The question is, for this particular additional 10%, do you think you can get more value, right, for that 10%, right? If you are, I guess you are. I believe that you are in the money to actually give that guy the 10% because you can get so much more. Always remember, 10% of a watermelon is bigger than 100% of a grape. So I think there's a question about strong founders and all that. I guess strong founders, I would say, is people like Alvin, right? Resilient, people with mental toughness. And the key question for me is, today, what will he do in times of crisis? Right?
That is true.
So one of the tactics we use, in case you are planning to pitch to me, is during our investment committee meeting. What will happen is you will see three of myself and my two other partners. One of them is actually online now, right? The three of us will come in as an investment committee and we'll do a rapid fire session. The idea is to test you and see how you perform under pressure, right? So different VCs have different styles. Our style is a little bit of a rapid fire where we keep pushing you and trying to find out about you as a person. We try to break you down. We try to find out who you really are, and we make you confront your inner demons, right? Only when that happens are you able to have a better evaluation of whether the founder is able to perform under pressure, because not forgetting that the customers are going to put on you even more pressure than the VC is ever going to do, right? Here's
Absolutely.
the thing: the VC is going to take a stake in your company for his or her money, right? That's what the investor does. The customer is paying you for your product or service, and if you can't perform up to standards, the customer is going to kill you.
Yes.
Right. Let me put it this way. I bought a hosting plan from Vodian before, and I think the customer service was solid. But what I can tell you is, if the customer service was not solid, Alvin will probably have a very, very hard time. Right? So the thing is, it's true, right? Because the customers are not getting anything other than your product and service. And if that is not up to their standards, the question then is, why am I still paying for your product and service?
Yeah, absolutely, man.
So the
I think,
pressure from
yeah,
customers is much bigger than the pressure from investors. So we want to simulate that condition.
yeah, yeah. I think that's absolutely true. Like in terms of a business, like for me, I am an entrepreneur. So when I look at businesses, I look at the value that I create for my customers. And that to me is the key. Marketing, advertising, whatever else we do is to amplify that. It's not that advertising and marketing, is the key, and then fulfillment and providing that kind of service to our customers is the secondary thing. That's not the case. The case is primarily the only reason why we exist as entrepreneurs, as our businesses, is to serve our customers, is to provide that kind of value that you're looking at. Because once they do that, once businesses actually create the value and deliver upon their word, then the customers are going to be happy. Then the customers are going to be telling their friends about you. Then the customers are going to be like renewing. And these are the things that I talk to my coaching clients about, right? Because you're looking at a customer journey. It's not a customer sale. This thing is going to be long. It's going to span weeks, months, years, even, because you're looking at not just customer acquisition but customer retention. How do you like acquire a customer and keep him for life? You don't just want to acquire a customer and then after that let him leave to your competitor. You want him to actually stay with you. You want to actually be able to serve them for life. So I think that's really important, and that's the way that I run my businesses. Wow, we have a lot of questions.
Yeah, man. This is
Yeah,
getting
so
interesting.
Alan has a comment. He has spoken to the founder of Pest Busters before, which is one of the more famous pest extermination companies in Singapore. And I think it makes a good point, right? If you think of everybody as a competitor, that is true. Because what is Pest Busters' solution, right? What is the value that they have for the customers that they serve? It's literally exterminating pests. So yes, his customers also are his competitors because, okay, what are the two alternatives? One is they go with pest busters. Two, they kill the mosquitoes themselves, right? That is just essentially it. In terms of businesses, that's the same thing as well. When I was running Vodian, yeah, you know what? You can buy services from me. I think my base plan is like $10 a month, or you can just try to do it yourself. You can create a server, run it from your home. It won't be stable, but you can. I mean, it's possible. So that theoretically is also my competitor, right? But to me, what I think is important is I provide a kind of value that is like, it's a no-brainer. Like, yeah, you can do that, but do you really want to do that? Do you really want to slap mosquitoes one by one to exterminate it all? To me, I'm providing a service for $10 a month. You don't have to worry about servers. You don't have to do it yourself. I do it for you. That's all that you pay, right? And to me, I think that's a fair exchange, and people get their value, get their money's worth, and they're happy. So that's a very, very interesting point about competition, Alan. He also mentioned another point. So depending on what kind of startups you have, I think deep tech startups have this benefit. There are a lot of grants available that you can actually use. So you do really need to give up equity, right? And you can actually get the kind of funding that you need, which is great, but you need to be deep tech. So yeah, it doesn't apply to everybody. Oh wow, this is a good question from Arthur. Okay, so so basically in this question that Arthur raised, it's basically ROI. Like you have all this time, like you have a limited time. Everybody has a limited time, especially in business. You're looking at a limited time. So we've got this is kind of like markets that we're facing right now. Like okay, especially to Lance as a VC, do you see like your ROI being compressed? Do you see like the time that you get your investment back? Do you see that being compressed, or is there something else that you're looking at?
If you're talking about investment period being compressed, I'm not surprised, right? Especially for seed funds, right? Because typically what happens is you are taken out by the time you hit Series C, Series D, when you hit the private equity stage, the investors tend to take you out because they say that you have too many. They'll tell the founder you have too many investors on your cap table. We're going to take them out, right, to clean everything up, right, to make life simple, right, for the business again. So what you see is you are starting to see more founders raising capital in a shorter period of time. But that being said, right, I feel that it really depends from business. It really depends on the business itself, right? If you're talking about something that is really deep tech, not so much. If you're talking about something that is general and all that, I do see the compression of returns in terms of timeline, right? But that is actually as far as our hurdle rate is concerned, what we are able to generate for our investors is concerned, is actually a plus point because for us, 5 years, right, to generate, let's say, 5x is much better than if you generate 5x over 8 years, right? Because if you understand how we actually calculate the time value of our returns, that's how it actually works on an exponential. The time actually works exponentially against you. So it's actually better for us. But having said that, you mentioned that wouldn't that lead to rash decisions or rushing to reap unripe fruits strategically? Maybe, right? I'm not surprised. I've seen VCs do that as well. But sometimes that's the name of the game, right? So a lot of people say, put it very bluntly, right? A lot of people say VC is a Ponzi scheme, in a sense. I think that's true in a sense because you are trying to take on the investment with hopes that somebody is willing to buy it at a high price, right? So that's why some people call VCs a Ponzi scheme. Yes and no, right? Yes, because that's essentially how I'm buying something in hopes that maybe Alvin could see more value in this company and willing to take my stake out. Let's say when I invest at the $10 million valuation, he's willing to take me out at a $30 million valuation, right? But the thing is because we already see value, right, in the company, and both sides see value. So the thing is, I see value at this point at an earlier stage, and say, okay, I think the company is worth 10 million because of what they have achieved so far and how they are going to grow. And maybe a private equity fund may see, okay, this company is worth $100 million because I think it can turn into a $1 billion company. They have too many investors on the cap table. Let us take them out and give them some returns, right? And take them out of the company structure. And sometimes you have no choice because your fund life is up. Sometimes you have no choice because there are other clauses like tag along, drag along, right? You are being dragged along by the big investors in that particular round. So these are certain terms that will trigger when you actually get a potential buyout from of parts of the company from a larger fund, right? So if you ask me, rash decisions not so much. Rushing to reap unripe fruit strategically, yes. Vodian customer service standards seem to drop after Alvin left.
Yeah, I mean that's something that I really like regret. I think like honestly, so guys, we talked about a lot about investors, right? Whether it's VC, angels, whatever. For my case, it's an acquirer, so it really depends whether or not there's strategic like similarities. So I think if you have a vision, then the buyer that you work with has to share that vision as well. So that is why I think in terms of like what we are talking about right now with Lance and I, venture capitalists, why it's so important to not just like think of in terms of money, right? Like you take this amount, whether it's 100K, 1 million, whatever it is. It's not just about the money. It's also about like who you bring on board. Because when you take on the money, this guy is going to be there hounding you. This guy is going to be there like influencing your decisions as a founder. This guy is going to be there compressing whatever you're facing. Like Arthur mentioned ROI, right? That's going to be compressed because of the people that you take on board. Imagine a VC that has a fund life of like 5 years. If he has a fund life of 5 years, and he's looking at your business, right? He's going to make you squeeze every profit or squeeze any margin that you have. If you're like, okay, let's improve customer service, he's going to be like, hey, no, don't spend on that. You know, you're wasting this kind of money. Let's focus on profits instead. So it is very, very different. And I urge you guys to really, really think about the kind of value that you're creating for your customers, and only look for an investor that can support you in the endeavor, rather than just somebody that can just take on board for the money and then after that have a terrible time. Yeah. Oh, Angeline asked. Yeah, wow. Lance, what do you think? I think you have more experience in this than I do. I think Angeline is asking, in terms of user acquisition, in terms of growing your customers, your users, does a free business model work in Asia?
Yes or no? Again, depends on the industry. I would say freemium models are better. Tend to be better. Let's say in China, apparently. VCs are willing to fund that. If you're talking about Southeast Asia in general, what I see is VCs tend to be a little bit more conservative. So they want to, yes, you may start off as a no-charge business model, but the question is, they will always ask you, how can you monetize?
Yeah.
Right? At the end of the day, right, they want to see a potential revenue model. Right? So if yes, what kind of user base really, again, depends on what kind of business you are in. For us, if you're talking about gaming, you're talking about gaming platform, I would expect something at least 30,000. Right. I mean the thing is I have spoken to some other VCs. They are expecting way more than that. They're saying that they're even telling me that, look, are you that is your standard that low? Right? Because they are looking for something like 300,000. They're looking for even 3 million. So I was like, okay. Then I asked them, what stage are you at? They told me Series A. I was like, yeah, that's why.
Yeah, absolutely, man. So I think people need to understand, like when you go to VC, it's not just VC. It's like VC, yes, but what stage? Even when you look at angel, what stage? Because angels also, there's like seed stage. Seed guys. Seed basically means you have nothing. You have like zero.
You really have nothing.
Yeah, you have a business model, guys. Like I want to sell books. That's it. That's your business model.
You have a 100 overpage business plan example.
Yeah.
That's it.
So that is seed. So when people join you for seed, you're basically just pitching an idea to them. And they are buying you, not really the idea, I guess, but they're buying you and the fact that you're confident in that idea. That's it.
Yeah.
So there is a lot of nuances, a lot of considerations when you look at this space. Yeah. Well,
I was just joking with my friends, right? The thing is, people call me as an investor. As far as VC is concerned, it depends on how you look at it. It may be investors, but if you ask me, I'm a little bit it sounds controversial, but I'm a little bit more inclined to say that we are gamblers, but we gamble on people. We gamble on people who can potentially make it.
Fair, yes.
Right?
That's true.
And the bets, typically you go to the Toto shop, right? You buy one bet is how much? Maybe like $7 if you buy a system 7. Over here, I'm talking about 70 grand. or thereabouts. So it's a crazy huge bet that fingers crossed will give you a crazy huge profit. Yeah.
Yeah. So we have a couple of questions. Daniel is asking, what's the difference between general tech and deep tech? I think I can help with that question. So when you talk about general tech, right, there's really like it's very general. It's like maybe like programming or whatever. But let's talk about deep tech. Deep tech has a very specialized focus in a specific niche, typically in terms of bioscience, medical, even engineering. AI, right? Like these sort of things, like very, very specialized in a specific niche. So when you talk about like self-driving cars, autonomous vehicles, food science, anything like that, like there's a very specific niche. That's typically deep tech or finance, even finance, fintech.
Yep.
That's also a niche. So that's deep tech.
Blockchain.
Yeah, blockchain, right?
Yep.
So
So the thing is, I always tell people, right? Yes, it may sound deep tech at the surface, but sometimes if you look deeper, it's not really deep tech. You know why? They call it. There's a reason why it's called buzzwords, right?
Yeah, exactly. So it's really, really dependent on the technology. Like you can say that you're AI, but if your AI is just based on if else, if else, if else, if else, and then there's a whole bunch of flow charts, not really AI, guys. Like so, but talking about stream, like, I just wanna like tell everybody, like if you guys are liking this, I think there's a lot of value here. If you guys are liking this, just like and share. We're doing this for free. Just pass on the love, guys. Pass it on to people that might benefit from this. We have a lot of questions. So John is asking, VC versus self-funded. Which options do you, and how works, and how do you weigh that decision? Okay, I can answer that because I'm a bootstrapped entrepreneur. To me, when I look at it, right, it's basically the cost of equity, I guess the cost of funds. So whenever you take on investment, right, it's not free. It is never free. When you take on investments, what are you giving up? Typically, people give up equity or debt. When you take on investments, either it's equity or debt. Like whether you give up your shares or whether you give up like in terms of paying for the interest. When I looked at it back then, I knew that I could grow the business organically. I knew that it was systematic. I knew that if I take on this amount of customers, I could buy this server and I could grow that way. So to me, I don't need external funds. But if you were, for example, maybe Facebook or Uber, then yes, you definitely you have a business model, you have an idea, it works in one business. Now you want to expand to the whole world, because the slower you are, the more competitors you have. And if the more competitors you have, the more risk you face, right? So for that, VC perfectly acceptable because you can scale, and the kind of scaling that you go through is not the regular scaling. It's not regular growth. You're talking about blitz scaling. Uber went from like the US market, San Francisco, to like everywhere in like 3 or 4 years.
Yep.
Typically because of funds. Like if you expand the market, you need what? You need manpower. You need funds. Yeah, you need capital. And if you do it yourself, it's going to take 10 years. They did it in like a matter of months.
Yeah. The thing is, I always tell people this, right? Depends on what is your objective. It goes back to what is our objective. If your objective is to grow the business or do something that's sustainable, and you don't mind, let's say, taking 7 years, 10 years, then I think you need to weigh what we call the cost of equity versus the cost of debt, right? In terms of if let's say, for example, you're just an idea stage, or you just started with a minimum viable product where you kind of know, hey, this product works. I'm not sure whether I have it in the market. Now I have run out of cash, right? So people go to VCs for 2 reasons. A, they already run out of cash and they really need capital injection, and they can't get loans, right? That is a very bad timing to go to a VC because you know that these guys are going to eat you alive.
Yeah.
Those sheets are going to be crazy. Okay, I've seen VCs that say, "Oh, I want 33% of your company. I'm willing to give you $100,000."
Yeah.
right? So the thing is, that's the worst time to go to a VC, right? The second group of that go to the VCs are typically saying that, look, I know I can get there in 10 years myself, but I want to get there in 3 years. I want you to help me get there in 3 years. So you are like what Arthur was mentioning earlier. You are actually kind of compressing your growth, right, by giving up part of your equity.
Yes.
You're compressing the growth of the company by we are targeting at least 3 to 4 times. So what you can achieve in 10 years by yourself, we are targeting to achieve it within 2.5 to 3 years.
Yes.
Right. So because that is the only way that we could ever get a good exit and make money for our investors. Right. So that's the idea. Right. You want to weigh the cost of each type of capital, right? Be it a loan, right? Or be it a sale of equity.
Yeah.
Right.
Absolutely.
Compare that at that particular point, whichever that is less expensive and fits your bill better. Right? Because not forgetting that when VCs give you that money, you technically don't have the obligation to pay them back. Although of course we have terms to try to protect our downside and stuff.
Yeah.
Technically, if your company goes bust, touch wood. I hope none of your companies go bust. But touch wood, if the company goes bust, you don't have to pay us back any single cent.
Yeah.
Right? As for loans, you got to pay back every single cent of your loan before you can take any cent out from your business. So the thing is, you need to consider this is what we call liquidation preference. Right? If you see VC term sheets, they typically talk about liquidation preference. That's what we are talking about. Right? Let's say, for example, you're talking about loans. They have a higher liquidation preference than equity. Meaning, you got to pay back your loans before you can take any money out from equity.
Yeah.
So you need to weigh the opportunity cost for both and decide for yourself. So there's no straight answer to that, right? But I hope that we have given you some guidelines, Jonathan. That is helpful, right? Yeah.
So I don't know if you guys know about this. Like when Lance was talking about like liquidity preferences, this happens everywhere. Any time that you take money, you have liquidity preferences. So if you guys are investors, like if you are investing in the capital markets, the difference between a bond and a share is also very, very different. One is a bond, one is like equity, right? Share, right? In terms of like, let's look at the worst case scenario where the company goes bankrupt. The company that you put money in goes bankrupt. Whether it's a bond or a share, goes bankrupt, right? The bondholder typically has higher liquidity preferences because he's usually the first or second charge. The charge order matters. Equity, in terms of shares and all that, right, is usually the fourth or fifth charge. It's after the company has paid off all his bonds or its loans. The loans are always first. And that's why with equity, you always get higher returns because there's a lot more risk that you take on.
Yep.
Yeah. So Jia Ai has like also mentioned that, guys, so this is coming from a lawyer. If you guys like this, this is free information that we're giving. If you like this, just share this. That's all that we ask for you so that we can do this more in the future. If you guys like this, just share it. Completely free, guys. Just click on the share button, get more people involved, get more people liking this, get more people understanding what we are doing. So very, very cool.
Yes, yes, it is the need for speed that the funds are required for scaling. Yeah, so that's when you go to a VC.
Yeah, and it's so much different because if you go to a VC and you're like pre-seed or seed, pre-revenue, or seed, you're like, hey, can you trust me? Can you believe in me? This is what I have, right? And the value proposition is very, very, very different. The value is not in the VC or whoever investor you're in. What Lance has talked about, Lance has said, if you come in a position where you're actually like, hey, I don't need the funds. In 10 years, I know I'll get there. But the only reason why you're coming on board or why I'm letting you come on board is because when I take your funds, I'm going to grow the company and scale it up so that what happened, what will typically take 10 years will now be like 2 or 3 years. Yeah, sure. I think that's a perfectly acceptable reason for taking on investment. I think that's fine. That puts value not in the VC's hand or the investor's hands, but in your hands, because you're determining it. You're already post revenue, you're very, very strong, you have a business model that works, you have monetization, and you're saying that all that you want to do is to speed up the process, to compress the process. Then, okay, Ken, everybody is on board, is aligned, you know what's going to happen. And I think that is something that will work for everybody. Yeah. Oh, VCs that have clawback.
Yes,
What do you
clawback
think,
clauses.
Yeah.
Well, let me put it this way. Clawbacks are there for a reason. Think about it this way. I have seen founders that have taken capital from VCs, right? Can you guys hear me?
Yeah.
I hope my network isn't screwing up. Yeah. So, anyways, the idea is today I've seen founders that that actually say, "Oh, I've taken money. Oh, now I'm going for my MBA, or now I'm going for my PhD, right?" And sorry to say this, I can't run the business anymore. So now what? Right? Or if let's say, for example, you don't hit a certain KPI that you promised, because of that, you hit something called a down round. Meaning, let's say I valued your company at $6 million. In the next round, the next guy values your company at say $4 million. So now what? I came in earlier, I paid a higher price. The next guy came in later, he got a better liquidation preference and he paid a lower price. I got to be compensated for that, man.
Yeah.
Right? So we're going to trigger something called anti-dilution. Right? What it means is we are going to receive free shares from your company, right, to correct for the liquidation, or to correct for the new valuation. So now instead of coming in at 6 million, I'm getting new shares to set me back as if I'm coming at 4. Right? So the thing is, yes, certain these are typically for protection of capital, but I've seen unreasonable. I think they are fine as long as they are reasonable. Usually you are talking about things like weighted average dilution, anti-dilution. You're talking about things like let's say founder vesting. So what it means is, for example, if today you are taking money from a VC and they say, hey, I'm going to vest 25% of your shares over 5 years with certain clauses. What it means is now you got to earn back your 25% of your shares, right? If you leave halfway, your shares are that leftover portion of your shares are forfeited, right? The reason behind that is so that in the case where the founder decides to leave the business, we are able to have enough equity to engage a new CEO to come in as a co-founder and put him in a position that he's incentivized to carry on building this business, right? So other safeguards that we have include, sometimes you see VCs that ask for what we call board seats. So we become a director in your company, right? Sometimes we get board observer seats. Basically, that means a director that does not have, sort of a director that you don't actually put on the list of register of directors, and they can't vote during board meetings, right? So we typically ask for information rights as well. We request for like CEO updates, unaudited financial statements, budgets. If a case we suspect fraud, which I think something happened recently, there was a case that was pretty big recently. Fraud. We have the right to appoint special auditors, right? Etc. So as I said about preference shares, so these guys, preference shares tend to rank one level higher than ordinary shares that founders hold, right? This is to protect our own capital. So what I mean by participating and non-participating means, if I'm talking about non-participating, which I typically do, I'm talking about either I receive back my capital or the amount I'm entitled to based on my shareholdings, whichever is higher. If I'm talking about participating, let's say I invest $100,000, I get back 100,000 first, and I split based on my shareholdings with you, as if ordinary share, right? So these are some of the requirements that VCs have will ask of founders, right? So don't be surprised if you see VCs giving you term sheets that talk about clawback clauses. It's normal. Just make sure it's not too draconian, right? Not make sure that it isn't like, oh, now I invest at $5 million valuation. If you don't hit 15 million valuation in your next round, I want to claw back until you don't know what, until the cows come home and stuff like that, right? Don't get to that level, but generally, if you're talking about weighted average anti-dilution and stuff, that's fine, because that's typical. That's the market practice.
Cool.
Question: what do you think about pre-revenue startups pricing themselves at millions of dollars? Again, depends, right? If you're a medtech company that requires like FDA approval, or you're a drug discovery company that requires FDA approval, yeah, typical. If you're talking about companies that come in with no product, no revenue, and this actually happened, Alvin, you will be surprised. This actually happened because somebody pitched something like that to me.
Really?
Cloud gaming company, trying to raise $5 million, raised $2 million previously, all thrown into product development. Nothing came out. Now trying to raise $5 million, throw another $2 million in product development, $500,000 in marketing and sales, and guess what? They're going to increase the staff count from 6 to 18 within 12 months. If that's the case, and I asked the founder, do you have revenues? No. Do you have users? No. Do you have customers? No. Do you have signed contracts? No. Do you what's your plan, right? If you're going to throw everything into product development and all that, are you serious? Yeah. So after the guy left, my partner was asking me, what's your take? All I said was she's delusional.
Yeah.
Right.
Yeah.
If you tell me millions of dollars, if you tell me, if let's say for example you are pre-revenue, you have some users and all that, yeah, you're talking about not too far off, like $2 or $3 million, I'm fine. Yes. If you're telling me like if you have no revenues, if some basic users and you expect $10 million, maybe in Silicon Valley, but not here.
Yeah, exactly. So that's one of the things that I tell my coaching clients as well. Like the very first thing that you need to do is validation. Like, do you even have a business model? Are people even willing to? Well, it doesn't have to be a paid thing, right? Like, are people even willing to be a member or a user of your service? Right? That is validation. That is the market telling you that whatever you are offering is of value to the people that you are serving. If you always just do product development, you have no users, no revenue, nothing at all, then you're in this like echo chamber, not echo chamber, you're just like well in yourself, right? And the market is not giving you feedback. The best way that I think that you can get feedback is from the market, because the market, I think, is the one source of truth that I believe in. You can have like all these grand ideas in your mind or in your team's minds, and you think that you have the best product ever, but then you release it and then nobody signs up, nobody buys, and I think that's terrible. So why not just cut short the process, just test, experiment, right? Like tell everybody like, hey, I have this product, who's interested, right? Or you come up with a prototype and be like, hey, you know what? This is like the first version, the beta version. If you guys are interested, like put your name down. Or even better, pre-order, like, Kickstarter, all those like crowdsourcing products. I think that's what they really, really prove, that you have an idea that people will be like excited and interested to back. So they actually put money there.
Yeah,
I think that makes it a really, really good like validation.
And the other thing is, as I mentioned before, anti-dilution, right? What it means also is a high valuation comes with a price.
Yes, absolutely.
If you don't meet that valuation, you're going to lose a huge part of your company.
Yeah.
Imagine that guy is raising at $50 million valuation, true story. And if the next round is $5 million, and I give her 5 million, she's screwed.
Yeah. Yeah. You're looking
Because
at
I'm going to take a huge chunk of her company.
10 times. It's like if the guy comes in at 10%, he's looking at 50%. 10 times. So yeah. So
there's a price. There's a price of high valuations, my friend. So you have to balance between valuation and where you are, because there is a price to pay, right, for every decision.
Yeah, there's a price to pay for everything. Like, we've got a couple of questions. I think we're going to wrap up real soon, but we have a couple of questions to answer. Oh wow, this is a really good question. Arthur is asking, what happens if, like, you can't work together? Then what happens? Well, okay, VC, what happens, Lance?
Typically, what we try to do is, after if we reach a point where we cannot resolve the conflict, we offer two choices, right? We either we offer the other investors as well as the founder the option to buy us out, right, at a particular valuation. Usually, it's a premium on the previous round. So, for example, we entered at 6. The current valuation example, let's say, is 40. We will take a premium, let's say 45, because the company has grown since then, right? So we have a estimate, let's say 45, and we say, look, we are willing to sell our stake to the people in the shareholders, right? Based on a $45 million valuation. Who wants to take it, right? So we exit. That's one method. The second method that I think is cleaner is to get a third party, right? If, let's say, for example, nobody wants to take up that stake, we get a third party to come in and say, look, we are willing to offer this our stake at this price. Let's negotiate. If you are okay, we'll sell our stake, and we just exit, right? And we try to let the founder run the business as much as possible, because we feel that the founder is in a much better position, right? So that, I think, are the two amicable exit avenues. Unfortunately, most cases what you see is liquidation. It's painful, right? But that's the unfortunate thing, right? You see a lot of VCs putting their companies into liquidation because of deadlocks, right? Again, it depends on how you write the term sheets, but I try to push for a secondary sale, what we call a secondary sale, meaning I sell my stake to another investor, right? Before a exit and acquirer, like what happened for Vodin's case, or my case previously, or an IPO, right? We get an acquirer in to take us out, right? So just for our stake, right? So if I own 1%, you buy out my 1%. If I own 3%, you buy out my 3%. That's it. So yeah, these are some of the amicable exits that you can be exploring with your investors, right? Hopefully things don't go to that point. Yeah, but yeah, something for you guys to think about.
Very cool. Okay, so this is a personal question. I think Ian is asking. Sure. Lance, what is your journey? Tell us more, man. You mentioned a little bit about it in terms of the company that you created, the cloud company that you created, and then after that you went into the VC scene, first as a limited partner, now as a managing partner. Tell us more, man. What is your journey?
Yeah, my journey started off as an entrepreneur. Built a company with my co-founder who was ex-Microsoft. Started the company because of pride reasons, but eventually turned into something that I wanted to, serve SMEs around the globe, right? To help them reduce their cost of human error, right? So we built a cloud computing business that allows us to, no worries, Ian. Yeah, to bridge what I call the on-premise software and on cloud software. We try to make the bridge, right? By using various algorithms and all that, right? Built that, sold that to one of our biggest clients in the States. Wanted to give back to the startup community. So started off as an angel investor, became a limited partner in multiple funds, just to diversify my portfolio, right? Because angel investing is high risk. So for friends who are exploring angel investing / VC venture investing, please note that this is a very high risk activity. I do not recommend you guys to throw every single cent you have into this. But the thing is, for me, it was about giving back. It's about helping to grow the next generation of founders. And then it came to a point where I said I got addicted, I got hooked, and now I need money. So I said, you know what, guys, let's raise a fund and see what we can do with it, right? See how much we can add value to the ecosystem, how much we can add value to the community. Yeah, so that's my journey in a nutshell, right? Hopefully not too boring, right? Of course not as successful as Alvin. So much more to learn from you, right? But yeah, that's just my little part of life for now.
Cool. All right. Thanks, Lance. I think we spent a lot of time answering questions, sharing our journey, and all that. It's really like 2 hours. Like I didn't even feel like the time went past, but
time flies, man.
Yeah, talking about this. I'm just gonna like share this. Like guys, if you guys are interested, like I am running a masterclass soon on scaling. I think this is particularly applicable to entrepreneurs and business owners. If you're interested, the link is there, alvinpo.com/masterclass. These are the dates for February. This is the dates that I have for February. And if you guys are interested, there's an early bird promotion right now. And to tell you the truth, this might be the last masterclass that I'm running right now at this kind of state that it's in, because I think it's not something that is very sustainable for me. It takes a lot of effort for me to do things like this. So if you guys are interested in a masterclass, I think you should go for it. This is the early bird promotion. And if you don't like it, there's a money back guarantee. Just go for it. If you're an entrepreneur and business owner, I highly, highly recommend you to go for it. And this is a good segue to what Lance is doing right now. Lance, why don't you tell everybody what you're doing? And I'm so proud of what you're doing.
Can you guys see my slides? Because apparently my StreamYard is having some issues.
Yeah, I can see the slide that.
The business and beer, my 2 gifts thing, right? Is it? Is it that one? Am I sharing that one, or is there some issues?
Are you sharing it in the stream? I don't think we. Oh my God, we just lost Lance. So Lance just left the stream. I don't know, maybe his computer crashed. But what Lance is offering is that he's giving a free ticket to my masterclass. So he created a link for anybody that's interested. If you go to the link alvinpo.promo.gamerforce.ventures, gamerforce.ventures is his venture capital fund. But I mean, if you are interested, just go to that link, and you can see what he's offering. He's basically offering a free ticket to my masterclass, and all you need to do is to just comment on why you should be selected.
Yeah,
it's good to get back.
Yeah. Alvin, do you mind if I share my screen for a bit?
Yeah.
So actually, I have 2 gifts. The first gift is like Alvin said, it's a ticket to his masterclass, right? For one lucky founder, as I was talking about this today, right? The discussion today is about scaling businesses, and that is when VCs come in handy. And you shouldn't be talking to VCs if you're not trying to scale, because we're gonna come after you if you don't.
Absolutely, man.
Right. So the thing is, you check the link is in this QR code, or you can just click on. You can just go to my Facebook post, which I created a redirection link, alvinpo.promo.gamerforce.ventures. Right. Just just go to that website. It should link you to my Facebook post. Just comment there why you think you should be selected. By the way, you have 3 days, right? You have 3 days, right? If you really want to join me, and I'm pretty sure that we are gonna really have a good time, right? You have 3 days to participate, right? To join me on in this masterclass. And my second gift is just now you probably seen a number of slides that I was using, right? I was just toggling between my slides and my StreamYard, right? Here's another thing, right? You get a chance to get a copy of this slide deck, right, that I was using, checking out by scanning the QR code here, right? Do note that there's a case-sensitive password, BnB and GFB, and note that this is this is under Creative Commons license, right? So so just go to that file, right? gofile.io/dl/lwdahj, right? It's only available until Jan 30th, Jan 31st, 0100 at 12 midnight. I'm going to cut it off because of the restrictions that I have based on what GoFile has given me, right? I'm going to cut it off by January 31st. So you have 13 days to go and download, right, this particular gift. So yeah, these are my two gifts, and I hope you like them, right? Hope this helped you guys as much as I enjoyed it. I hope you enjoyed it just like how I enjoyed it, right? It's pretty cool. Getting to speak to such a successful guy like Alvin, you know.
Oh, thank you. I think a lot of people got value from this. Like we got like Julie, Angeline, Sam, Ian, Arthur, Melvin, all like you know, they really got value from this. So if you guys got value from this, just drop us a comment. Let us know. We read every single comment as you guys have seen. So drop us a comment. We really appreciate you guys being here. I think this is great because this creates conversation. This creates like awareness and education about not just entrepreneurship, but like on the other side of the fence, like how do investors look at entrepreneurs? How do investors look at businesses, right? And what it really takes to create a successful business. So thank you all for being here. Once again, if you guys are interested, I think these are the two main promos that we have. If you guys are interested in my masterclass, it is available at alvinpo.com/masterclass. And if you guys want to take part in the promotion that Lance has, which is something that is very generously given, which is a free ticket to my masterclass. If you guys are interested in that, he has created a URL just for you. It's alvinpopromo.gamerforce.ventures. So go check it out. Once again, thank you all for your time, and we really, really appreciate you, and we are glad that you got value from this. Lance, do you have any last words for everybody?
Hey guys, it was great sharing what I know and seeing the different comments. I'm glad that we added value to you guys. All right. Thanks for joining us. I look forward to seeing you guys soon. Right. If you wanna pitch to VCs, remember three important things. A, be prepared to scale like nobody's business because these guys are gonna push you. B, pick the right VCs for you because they may not be different. And C, don't be hopped up over valuations because A, there's a price to pay. B, you want to get a VC who can add value to you guys, right? So I look forward to seeing you guys. Hopefully we can work together someday, right? Jiayous, right? All the best for your businesses. I look forward to your successes in your future endeavors.
All right. Thanks so much, guys. We're going to end the broadcast right now. All right.